Hello everybody, Luke Gromen, FFTT. Hope everybody's well. Sorry I'm a couple minutes late. I was watching Phil Mickelson walk up to the 18th hole, so no spoiler alerts. I had to pause the TV. Kind of exciting for us old guys to one of us old guys to be leading a major so late. So rooting for Phil, good guy. So let's jump right into it here. The first question came from Prof. He said, you sold the majority of your Bitcoin almost at the top. What was the thought process behind you selling? I wish it was almost at the top. It wasn't at the top. It was, call it the 48,000 to 52,000 range. It was the majority of my Bitcoin. I still own Bitcoin. I still like Bitcoin. But what we wrote to our Tree Ring subscribers a week ago Friday, so the 14th of May, was that it seemed like the regulatory risk of Bitcoin had risen meaningfully in the prior 2 weeks. First off, somebody who I respect greatly, Harold Malmgren, who's very tied in, warned or highlighted that the IRS would consider Bitcoin property and would be able to confiscate Bitcoin for unpaid taxes. To me, that also raised the possibility of talking about taxing property on assessing property taxes. I've not seen anything about that, but that seemed to open that door when Harold talked about that. We saw Binance being investigated by the Department of Justice. A headline came out that week. We saw Bitcoin very publicly was cited as being paid as ransom in the Colonial Pipeline attack, which to me also got thrown in the pile with greater regulatory pressure or concern. And then just this continued environmental narrative that it's bad for the environment, which I think is largely crap, but it is what it is. You can tell the narrative being spun by mainstream media that it's a narrative. And so when we said that we sold most of our Bitcoin, I finished that Tree Ring section by writing, quote, with all that said, as Bitcoin bulls, what is FFT doing to hedge what appears to be rapidly rising political risk to Bitcoin and other cryptos? Our strategy is twofold. First, we continue to add to other inflation hedges, both those seen as future reserve assets by other nations, i.e. gold, and to quote-unquote politically acceptable inflation hedges, equities. Secondly, this week I sold enough Bitcoin to pay off substantially all of my family's personal debt, and I also set aside to pay the taxes on the gains. My thought is that I don't know what will happen to Bitcoin politically, but if at the very least Bitcoin has allowed me to deleverage my family pretty much entirely, then from then I'm playing with house money with the Bitcoin I have left, regardless of whether it goes up a lot from here or goes to zero. Bitcoin will have helped me liquidate most of my personal debts, which is in my view always a major win. In my opinion, the seeming increasing political risk to Bitcoin and the crypto area more broadly may come to nothing, but wanted to share my thoughts on it. Personally, knowing I'm playing with house money from this point allows me to sleep much better at night. So that's why I did what I did. I still really like Bitcoin, and I will be. I still want to add to it, but for the moment, I'm not adding to it now. So that's the thought process there. Second question from Tamai. Thanks, Luke. Why do you prefer the big tech in this current environment? As I've heard you saying in many YouTube videos, this seems to be contradictory to your commodities, gold, or Bitcoin picks, which are good in inflationary and debasement scenarios. How does big tech fit in? Record sovereign debt levels means that real rates likely have to go very negative, and tech stocks have done very well with negative real rates. And so I think this is one way that this cycle is likely to be a little different than pretty much any of the cycles we've had over the last 50 years, which is to say, I think both commodities and your traditional reflation plays do well, but then I also think tech also does well because the sovereign debt component this time means you have to have financial repression to keep real rates negative so the sovereign can grow out of their debt, which in my opinion means tech should also do well. From Vic, where are we in the cycle? I think we're early in the business cycle, and I think we are very, very, very late in the long-term debt cycle. We've talked a number of times about how we had an equity bubble, it blew up or it popped. We kicked the problems upstairs to the housing market. We created a housing bubble to paper over the lost demand from the equity bubble bursting. The housing bubble popped. We kicked the problems upstairs to the sovereign. Now we have a sovereign debt bubble, and there's nowhere to kick that upstairs to the except to the currency itself by debasing the currency. So that's where I think we are, and I think it's important to remember most people are simply looking at the short-term cycle of, hey, it's a reflationary trade. I need to own commodities and banks and industrials, and agree, particularly on the commodities and industrials. But virtually nobody is also saying we're also very, very late in the long-term debt cycle. And that means things that you might not want to own in a typical early cycle and the short cycle, things like gold, things like Bitcoin, things like negative real rate beneficiaries like tech. Those things you need to own this time because we're at the very, very tail end of a long-term debt cycle. Let's see, next question. Solar from, I'm reading more and more on FinTwit about the upcoming Basel III new rules coming on June 28th in Europe and I believe the US. Those go live in the UK as it stands now on January 1st. There is a growing belief that the excessive price suppression, gold paper trading will be heavily impaired by these rules. Any thoughts on it? This ties into another question as well from OC where he said, what thoughts, what stories that are hiding out in the open are you noticing? This is one of those stories that is hiding right out in the open. Anyone can look at it. Anyone can read it. I would highly encourage you to go read what Alistair MacLeod has written about it. It's excellent. He wrote something on the 13th of May and something again on the 20th of May. To me, it does seem like this is designed, these regulations from the BIS are designed to force the unwind of the allocated gold market to a large extent, centered in London. And if so, that could really be positive for the price of gold as we move into the back half of this year and then into 2022 and beyond. I'm really reticent to get too excited about it. Some of that's because I'm so scarred as anyone else that's owned gold for so long. We've seen these types of things before where this is it. It's going to be named HQLA, or this is it, and then inevitably Lucy pulls the football away from Charlie Brown, so to speak, and it doesn't happen. So I'm reticent to say this is it, here we go, it's all going to happen at once. With that said, the language does seem very likely to force an unwind in the unallocated gold market of some magnitude centered in London. All else equal to be quite positive for gold prices over time. So let's watch, as I like to write in tree rings. Things can still change, but I do think it could be a potentially important development as we look after the back half of this year. From Todd, given what is going on in reverse repo and sloppier long-end auctions, is an actual operation twist coming soon with an actual sale of short-end securities from the Fed balance sheet, an equivalent increase in long-end purchases? Could this be why nominal treasury yields are weak last week? I think we're already seeing a mini twist already. In fact, they really announced a very mini twist, they being the Fed, last week, where they sold a little bit out of the front end and bought a little bit more at the long end. They announced that they would be doing that going forward. That process has started if you look at the data. It's not a huge deal. The people in the technical and plumbing side of the business will say, oh, it's not a big deal yet. I agree. Nominally, technically, it's not that big a deal. The amounts aren't that big yet. However, to the extent that we know the Fed absolutely wants to avoid yield curve control, and I think we can infer that based on their pronouncements and other conversations I've had, this is a small step in that direction. They're trying to control the shape of the curve. I would call it more yield curve management than yield curve control, but all else equal, to me, it's a step in that direction that we think they're going anyway. So I think it's an important signpost. So let's see what happens. But that operation twist, at least mini twist, if you will, in my view, has already started. From Knox, Biden proposes cutting supply chain from infrastructure plan. WTF? Question mark. You know what, Knox? That was my reaction too. This doesn't make sense to me. I don't know if the Larry Summers and Bill Dudley wing of Washington have gotten to people in the Biden administration that. With the fear-mongering about inflation and what have you. Maybe it's just political positioning in terms of negotiating with the Republicans, which, if gun to my head today with as little as I know about it, is probably what it is. But it doesn't make sense, but I do think it's really important to watch, because anything that sends U.S. GDP growth lower will send U.S. real rates higher. And anything that sends U.S. GDP rates, or excuse me, U.S. real rates higher when U.S. debt to GDP is 130%, is problematic for pretty much every risk asset out there. It would, all else equal, probably be good for the dollar, good for volatility, not a lot else. So let's see how that develops. And then finally, from OM, I'm a fan and FFTT subscriber. Thank you very much for your business. We appreciate it. Please explain why Lacey Hunt and Stephen Van Meter and EPB Research, Eric Basmajian, I think is his last name, are wrong about transitory inflation. You don't believe the money multiplier and velocity tell the true secular story. It's I guess two separate answers. The velocity side tells us what's going on in the real economy, not the asset market side. If you want to see velocity in the asset market side, it's the chart of the S&P 500. Remember, people say, oh, well, we're just Japan on a leg. The Nikkei fell for 30 years, 25 years. The NASDAQ, the S&P is at all-time highs. There's your velocity on asset prices. Home prices are at all-time highs. There's your velocity on asset prices. Bond prices are near all-time highs. Bitcoin, etc. I mean, we have an everything bubble. So the financial side of velocity, the asset price side of velocity is very, very high. Maybe it's shrinking a little bit with what we've seen in cryptos this weekend, last couple weeks. Who knows? But the real economy side, the velocity, I do think is lower. But again, you have to take velocity, in my opinion, with a big block of salt because it's just a calculation. It's a plug of a calculation. It's MV equals PQ. So it's the velocity times the money supply equals the price or inflation times the actual real GDP growth. So we don't fully know money supply, as Jeff Snyder says. We are underpricing or undermanaging, undercounting inflation intentionally to help save the bond market. We have an okay read of what real GDP is now that we are hedonically adjusting technology devices, etc. So what's happening with velocity to me is in the real economy at the lows is marginally useful. Now, with that said, that's sort of one reason why that I don't put a lot of stock necessarily in what velocity is doing. With that said, to me, the reason why I don't think it's transitory is pretty much what Stan Druckenmiller told us on CNBC 2 weeks ago, which I don't think people listen to that full interview enough, and I think they need to listen to it about 3 or 4 or 5 times until they really hear what he's saying. But the point is this. Deflation with U.S. debt to GDP at 130%, and with the U.S.'s true interest expense already over 100% of tax receipts, and we define true interest expense as interest expense plus, Treasury spending plus entitlement pay-as-you-goes. If you have deflation in that environment, like these guys are looking for, the U.S. will miss interest payments on Treasuries. They will call Treasury holders and say, we're not making the payment this month unless the Fed prints the money. Or they'll call all baby boom generation, say we're not making the payments on entitlements this month unless the Fed prints the money. And so, in other words, the U.S. has a balance of payments problem because the debt is so high and foreigners are not buying enough of it. And I think those are the two things these gentlemen respectfully are all missing. Deflation's not a policy option anymore given the level of debt, given the lack of foreign buying. And what will happen if you do have deflation is the Treasury market will sell off with deflation. And that was speculative on my part up until March 2020. Remember, the Treasury market crashed alongside equities in March of 2020 after a brief period where it rose and then crashed. In October 2020, we saw the S&P and the NASDAQ fall 6-7% on renewed COVID fears. TLT was down that week. A couple weeks ago, we saw stocks off sharply. TLT was down, and TLT's down. That means yields are going up. So that's to me is ultimately the issue. Deflation is not a policy option given our debt levels and given the lack of foreign buying of treasuries. So it's not to say you can't have it in small dribs and drabs. Clearly we had that in March of 2020, October 2020, earlier this month in asset markets. But the Fed's not going to let it happen for long, and that's where we differ. So with that, I'm going to wrap it up for the night. I wanted to say thank you for everyone for joining us. As always, check us out at FFTT-LLC.com for more information on what we're up to, more information about tree rings, and that way you can read real time some of the things we're writing, like what highlighted earlier as it related to Bitcoin a week and a half ago. So at any rate, everybody, have a great rest of the night, a great week, and we will talk with you guys soon. Take care, everybody.